Zach, I appreciate you taking the time out to join us today.
Peter, thanks so much for having me. Excited to be here.
Yeah. Well, before we get into what you're doing today, can you give us a little background for the audience, people that don't know you and everything else? Explain, who you are, how you got into, the space for rent to retirement and everything else.
I'd love to. Thanks for that, Peter. So, I have a background nothing to do with real estate, as many people do when they find themselves to real estate. So my wife and I are both optometrists by education. We met in school. I was on scholarship with the Air Force, so I immediately joined the Air Force after graduating from professional school, and I was a captain in the Air Force for 7 years, practicing optometry. That's where I started investing in real estate because I had the unique benefit of having access to a VA loan. First house I bought was a duplex, so house hacked it, lived in half, rented out the other half, got the real estate bug. I was always interested to real estate. Obviously, read all the books and stuff. It made sense to me as a tangible asset, and that solidified the fact when we made our first investment, which was the house hack, that like, hey, this is pretty easy to follow the numbers, right? You have a physical asset, tenant's paying the mortgage. I'm buying a property with actually, well, in this case, very little money down out of pocket, and it's growing in appreciation and leverage and tax benefits, all the other things. So the next year we bought 2 more duplexes, and this is probably about 15 years ago at this point. Just continued to invest from there. There was a pivotal moment, Peter, that really changed the trajectory of our lives and our investing career path. And this was probably about year 4 or 5 into our investing. We were just traditionally investing locally, self-managing everything. So, single family and small multifamily residential real estate. We determined, and when I say we, my wife and I started looking out of state. We started to look at different markets and evaluate different markets because we thought that, hey, like we're in this local market, but as we started to explore other markets, we quickly found out that there are other markets that had better opportunity, better returns, that were more compatible with our goals. And so we decided to take the leap to learn how to invest out of state in markets that we saw opportunity in. And that wasn't easy. We made a lot of mistakes and had challenges, of course, which we certainly can talk about. But, once we kind of figured it out, we created a system around identifying first the markets and then building teams in those areas. It just skyrocketed our investment portfolio to the point where we were able to retire in our 30s from our career path as doctors, and actually replace our income. We had a lot of people that started looking at that saying, hey, that we see the success you're having in rental real estate. That's really cool. We want to also do the same thing, learn how to invest, although we don't have the time, the energy, the knowledge. Some of our optometry colleagues were also asking. And so we decided, like, hey, we already have the teams and systems established to do this for ourselves. Why not help other people do the same thing, invest alongside us in these different areas, and learn how to create a sustainable investment portfolio? And that was the birthplace of rent to retirement about 10 years ago. So fast forward to where we're at today. I mean, we did over 1,000 houses last year. A majority of those are build to rent properties in the residential sector. We work in the Midwest and Southeast across 12 different markets. And our goal is to bring the best investment opportunities across the country to our investors, where we handle everything for you in a turnkey type of nature. So hopefully that gives you a quick summary on me.
No, that's good. A lot to dig into. So before we go back real quick, since you're talking about rent to retirement, tell me, if I called your company today and I say, hey, I want to invest, what does that look like for me?
So we are a turnkey company. I almost hate that word. It's one of those buzzwords, but essentially we identify the best markets throughout the country to invest and build our local teams in those areas and systems. So you as the investor has access to get started, diversify, or scale in different markets where the real estate fundamentals and opportunity fits your goals. The first thing we do with our investors is get on a consultation with you to talk about those goals. I mean, everyone's on an individual plan to determine, what you ultimately want to accomplish in real estate. And then we look at the markets that we participate in and see if there's inventory available that matches your goals. When we talk about turnkey real estate, these are properties that are either fully renovated or newly built. Majority of what we do is new construction, built to rent. So they're newly built, leased, and professionally managed by our teams in these different areas, where you can come in as an investor and buy real estate without having to necessarily buy yourself another job and actively manage. And we assist with a lot of things. I mean, building out a comprehensive business plan. I mean, do you need an LLC? Well, how does the tax structure work? We want to make sure you have the right lenders and title agents, everything, right? Insurance. So we want to help people build a comprehensive business plan. But the first conversation is like, let's talk about what your investment goals are. Have you started investing in real estate? Have you invested out of state? What obstacles have you had? What is your financing? And resource picture look like? What are you ultimately wanting to accomplish in that 1, 5, 10-year time frame?
So let's go back. You just spoke about actually investing out of state. So you guys were investing. Where were you guys investing initially? And then you said, okay, hey, we can take this out of state because it's going to make more sense for us.
I was stationed as a young captain. Even my first year out of school, I was stationed in Grand Forks, North Dakota. I say I was deployed there because it's not not necessarily a favorable place to live, and the real estate's okay, but
Yeah.
it's not it's not a highly sought after area. And so we're like, hey, this is doing okay, with our current portfolio. But we started to see other markets where it's like, hey, we can actually buy cheaper houses that have better appreciation, triple the cash flow. Like, it's in the path of progress. That's going to set us up for future success. And so we started to learn how to invest out of state into those markets where there's better opportunity.
Yeah. So building out teams in those other markets, so how'd you go about that 10, 12 years ago when you started on your own investing out of state? And how has that changed systems wise to today?
Oh man, we made every mistake in the book, Peter. Is very much just like, I mean, a little on a rudimentary scale. I mean, a lot of people start this way, I think, because if you're doing it on your own, you may not have some guidance and advice on where to go. We certainly called local agents and brokers and contractors, and we didn't have a good system to identify which are the ones we should be working with, versus just working with the first guy we liked on a phone call, but
Yeah.
we just we looked at a couple areas on the map and looked at home prices and thought that, like, hey, we know kind of what. We did some research on rents, and this was very rudimentary Zillow type research, right, initially. And we just bought some properties, and we made a lot of mistakes. Like, our first out of state property was Southside Chicago, on a house. It actually had already been renovated by a local contractor who was marketing it. Terrible location, D-class area, great renovations. Numbers looked very favorable on paper. And he was kind of operating a lot of people, when they hear turnkey, that's kind of what you think about a little bit.
Yeah.
So it's you have to be cautious as an out-of-state investor on who you're working with, which locations you're investing in. Those properties turned out terribly. We just had tenant turnover all the time, dealing with Section 8, Chicago Housing Authority. So we ended up taking a loss on those, selling them, and then reinventing the wheel just really slowly over time. Like, let's build our own contracting team. Let's find our own property managers. And sometimes you have to work with 10 or 20 bad ones before you find the ones that, you can interview them, you can ask for references, but man, at the end of the day, just empirical data of actually working with people, you hang on to the good ones and you cut ties with the bad ones early on and cut your losses. But man, it's just I guess school of hard knocks, really, and trying to be in areas where the population was moving fundamentally, like where there is an undersupply of housing, where people are moving, and where there was housing demand.
Yeah. Okay. So you brought up really good key points, especially when you guys go into market, try to get into a market because you see the property, it's newly renovated, you don't really know the area, and then all of a sudden, you take these hits and you sell for a loss. Why at that point did you guys say, okay, hey, we're out completely? What motivated you to keep going? Because Zach, there's been a lot of people, and I know you've probably talked to them and stuff like that come to you, at age 50 or 40 or, whatever age, and said, hey, I tried this 15 years ago and I failed and I never picked it back up until now. Or I never picked it back up because it just wasn't for me because I ran into so many roadblocks. What made you different in that scenario?
I've always looked at real estate investing as a lifelong journey, right? And this is something that's like, hey, if we're going to do it, I'm very thick-headed and just like determined to figure it out. I always looked at it as a loss, as an opportunity to learn and improve. And so, and I think, and that's in many facets of life, but I think that with real estate, we'd at least been fundamentally successful in our local portfolio. And we knew, like, hey, there's got to be a better way to figure this out. And we also just reviewed, we were very sloppy and lazy in our first acquisitions. But we started to join it. By that point, when we started to invest out of state, we were in RIA groups and, starting to network with other people. And we did, we could see other people that were successful doing it. And so we were like, hey, there's gotta be a way to figure it out. You know what I mean?
Okay. Yeah. No, 100%. And that's the people that you talk to, and they lose a couple, and then all of a sudden, they start picking it up, and their fourth, fifth, sixth are, amazing deals because they were able to really learn from that. a lot of people you talk to, the bad horror stories, they didn't do it right the first one and then they never got back into it. So they're, more negative on the experience, and maybe they pick it up later in life. So moving forward on actually doing due diligence for picking up contractors in those areas or building out your team, how did you transition from picking up normal contractors from the day-to-day to, hey, we're going to build out a team of contractors in this area?
Yeah, I think once we had a more established footprint, Peter, in some of these areas, it's almost like the good people came to us. Now that didn't happen initially. We kind of, a lot of times we were just searching for contractors on different online resources and eventually local RIA groups. And, eventually you meet with the right people. It's all networking. This is a people business like anything else. So we networked with other people that were successful in those areas, and they had their established teams, and they weren't necessarily going to give up their best contractors, right? But they were at least well networked where they could say, you should talk to this person or things like that. So having referrals from people that were well established in that area certainly helped to expedite working with the right people. And they weren't always the right people. But that was a starting point. The problem is if you're entering into a new market and you don't have a resource to, expedite your contact with the right people, then you're just, throwing a dart at the dartboard and just trying to find the right people. And with anything, this is still the case with anything, is that, we hire on multiple people with the intention with understanding not everyone's going to work out, but hey, the guys that do work out, that show up on time, that provide quality work, that are accountable, we overpay them and we want to hold on to them.
Yes, 100%. And you'll go into that. That's for agents, that's for lenders, that's for everybody else. You'll find the ones and you'll keep the ones that are good, and you'll let go of the bad ones. When you're talking about building out contractors in specific markets, are you talking about actually for now with your business model? Are you guys actually licensed in that market as a contractor and building those properties or renovating those properties? Or are you hiring that contractor that's licensed in that state and they're doing all the work, but you're vetting them and everything else and getting things up and running?
Yeah, I'm not a licensed GC, right? We're hiring local professionals and sometimes bringing our team to these areas, right? Okay. So the goal would, and mainly at this point, we work in new construction. So these are building contractors. We do have some contractors that do renovation in a couple markets in the Midwest, like Ohio and Indiana, but for the most part, we're doing ground up construction. And I really enjoy new construction. Construction has its own challenges through the construction process, but the end result, having a property that's newly built in an up and coming area where you're really limiting your maintenance and capital expenditures, it makes it a more predictable experience. Better overall returns, better appreciation, both the rents and home prices over time. There's just so much more upside. But we are hiring builders and contractors in the areas that we're focusing on, or bringing our own team now at this point to those areas.
Okay, cool. And then how are you guys finding the lots to build on these? Do you have agents in the area?
Yeah, absolutely. That would all become through agents or people that are, even some wholesalers if they're wholesaling lots. There's large companies that are land banks as well that sometimes we buy from. We don't do community development. We mainly do infill lots, and these are areas where the market can absorb a certain percentage. That's one thing we want to look at, is market absorption rate for how many houses can we build in this area where there's still going to be rental demand and we're not going to oversaturate it. So it's typically infill lots in a lot of these established communities in the Southeast. Some of our major areas that we build in is Huntsville and surrounding areas. We work in a town called Harvest, which is just northeast or northwest of Alabama, or of Huntsville. And this is just a growing area that has better school districts than Huntsville area proper. And man, it's just huge demand. Also Birmingham, we work in like areas in Southwest Florida, like Cape Coral, Northport, Port Charlotte, as well as Central Florida, areas like Ocala, Texas, Carolinas. These are areas that, have an undersupply of housing. And really, we're not worried about saturation there because all the builders combined cannot keep up with the supply there. So.
Okay, so tell me some other data points that you're looking at when you're looking at a market. If I brought you a market and said, "Hey, Zach, let's go into this market," what things outside of what you just explained for absorption and everything else on rents, um, what are you looking for? What are some key points and key indicators that say, "Yeah, this is a good market," or "Peter, no, we're not going to go into this market"?
There's a lot of different things, and it's changed over the past 12 months. We want to be in areas that and I don't have defined metrics for supply and demand, but it's pretty easy to tell. I guess you could look at inventory availability. Where the average inventory availability might be 6 months. A lot of these areas have 1 to 2 months availability. We want to look at population growth. A lot of the markets that we focus on have over 2% per year population growth.
Okay.
That's certainly true for the Southeast. We try to focus on residential real estate, single family and small multi, that is below the median house price point. So just
Okay.
checking this morning, actually, median house price point is 408,000. That's actually down from 436 months ago. We
Hmm.
try to be in for 350 or less. A lot of the areas we're in the high 200s, because
Okay.
that gives you the best opportunity for upside. You know what I mean?
Yes.
Regardless of what's going on in the market. So we try to be sub median house price point, both for that area, but also on a national level. Rents, I mean, people talk about rent to price ratio and things like that. I mean, at least a 0.6 or 60% rent to price ratio is like where we try to be for rents. I mean, on new construction, that's the one thing. A lot of these areas may not be great positive cash flow year one. We don't necessarily build stuff that's going to be negative cash flow, but in the right market, I'm okay with break even cash flow, with especially with where current debt is, because we know that we're going to refi in probably 1 to 2 years. But also, I think we're in growth areas, right? So these are areas where, hey, on paper, the returns are not going to be crazy attractive today, but certainly when 1, 2, 3 years, I mean, you're going to have strong appreciation. You'll have immediate equity coming into it, and you'll have rent growth, likely in the double digits year after year. So those are some of the metrics we look at.
Okay, so explain to me, especially if you have an investor that comes to you and says, "Hey, I want to get in. I want to be able to buy something, and it makes sense." A lot of people will come to me and they say, "Hey, this doesn't really make sense because it's you're barely breaking even." But just like you explained, you look forward for the next year, 2, 3, 4 years where it's exponential rent growth, depending state, demand, everything else. So if I come to you and you just explain, "Hey, we're there breaking even or right there at that line." How do I get buy? How do you get buy-in from other people where it's like, "Yeah, that makes sense"?
And that was just one specific example. Like when we're working with investors, it's all about their goals and their criteria, their buy box, right? Most of our properties, and that's our inventory is publicly available, on our website. We'll have 60 plus houses for sale across the country at any point in time. These are off-market deals that are specifically ones that we've rehabbed or built, leased and managed, turnkey deals ready to go. Most of them have between an 8 to 12% cash on cash ROI. So most of them are positive cash flow. Some of them, some of them even have, some equity portion coming into it when you're purchasing, because right now is a unique time, I think, where you have more access to inventory with less investor activity. But it's about matching the investor with the right opportunity that does fit their goals. So most things are positive cash flow to some degree. But I will say, like a perfect example of this, Peter, would be that we always try to bring creative financing options to the forefront for people as well, based on their goals. For example, we have a 3% seller financed option. It's an interest only 2 to 4 year note on some of the new construction that we're offering. Those things cash flow like crazy, but you would need to have an exit strategy, right, in 2 to 4 years. We also have a partnership with a local credit union that will do as little as 5% down on up to 5 investment properties. So in that scenario, these are true investment properties. This is a portfolio loan through the credit union if you qualify. In that scenario, you could leverage 95% of the property and really stretch your capital further. But that's likely a negative cash flow scenario if you do that. And you don't have to do that, but that could be a unique scenario if you're an investor that maybe has some reserves and can weather a little bit of negative cash flow, but expand your portfolio, right? If you had 25% down to buy one property, you could buy 5 similar properties at 5% down. You just need to obviously understand the investment strategy. For people that do cost segregation studies and accelerated depreciation, like I do on everything I buy, I mean, that's a great way to just maximize the tax benefits. So I will trade a little negative cash flow because, again, I know in a few years it's going to be positive. But it's all about matching the goals and criteria with your goals and or matching the inventory with your goals, resources, timeline, buy box, etc., and building out a strategy and a plan around that, right?
Yes. Yeah. No, I agree. I mean, my market, my direct market is I face a lot of those conversations is, hey, I want a house hack. I want to, buy the property. Well, in most states outside of California, excluding some other big states like New York, for instance, you're going to be in a situation where you house hack and maybe you're making $200 to $500 or $1,000 a month on those people that are living there with you. But my scenario is usually you're just saving a little bit on, or maybe a good amount on what you would be spending on a single family that you just moved into with a family, or yourself. So that's why I want to dig in on that specific example that you gave me, because you don't know what that person's exact, for one, buy box is and what they're looking for on an investment. Some people want to be within their market that they live in, and they want to buy something for their first property and house hack it. You have an equity position, you're putting less money down so you can have the ability to go invest somewhere else, out of state or in state. And you have a little bit more fluidity with that situation comparatively to, just putting 25% down and, okay, well, I'm not going to be able to invest for another 5 years because I have 25% in on this fourplex. So I like how you gave that breakdown. It really depends on the structure of what the person's looking for. And I think a lot of people, in real estate will look at it and say, or just kind of going back to your example, hey, I had 2, misses or 1 miss on my investment, but then we restructured and re-examined what we were doing. And we figured out, what areas we should be buying in, and we got rid of those. Same thing with the investing. Hey, it would be nicer to have 5 properties with 5% down. Yes, it's not going to cash flow $3,000 a month right out of the gate, but we can work up to that. I can buy more properties with a 1 hit versus, buying one with 1 hit.
Yeah, I think it's important to really run the math on when you're establishing like your own buy box and investment goals and criteria. Like, look at so many people, I think, Peter, I don't know if you experienced this, but at least newer investors, they're really hyper focused on like just year one, right? And especially just like the cash flow. So people seem to be so hyper focused when you're looking at a pro forma or analyzing a property just on cash flow year one. And it's like, to me, that almost is, yes, cash flow is important, but most people are like not retiring off of cash flow year one, right? I mean, it's a long game.
Property.
Yeah, exactly. So, I mean, the thing is that real estate, we all know real estate builds wealth over time. Cash flow is a byproduct, and that cash flow grows over time. A lot of people forget that fact that, again, when you're looking at year one analysis, it's like, that's the cash flow, projected cash flow for that year. And yes, that's important. You want it to be positive. I think a lot of people, that's tangible for them because they can say, if this is cash flowing $300 a month and I had 10 of these properties, well, it covers my expenses at $3K a month or whatever the case is. But they're not super forward thinking. Real estate, it takes time. There's not an overnight thing, but if you can invest in growth areas and have a strategy and plan and do that consistently, it's all the other things in rental real estate that really create wealth. Right? It's using leverage strategically. It's understanding leverage. It's understanding, the tax benefits of rental real estate, which most people don't fully understand. And that is the biggest, make no mistake, that is the biggest benefit to investing in real estate. And then coupling that with business is you can far exceed your returns through real estate than any other thing you invest in, just through the tax benefits. Also understanding how equity, appreciation, the tenant paying the loan down for you, all those things are what builds wealth over time. It just takes some time. So cash flow is important, but maybe learn how to run the math on those other things, because that's the light bulb went off for us. I know during our career path when we stopped paying attention so much to just immediate cash flow and looking at how do we build wealth in rental real estate and how do we quantify that. It's hard for people to run the numbers on, but I think it's important.
Yeah, I agree with that. All your explanation for each person, looking at a scenario is, I want a cash flow today because, this is going to be a bad investment, or, and then utilizing, these things that do come up, for instance, short-term rentals, bonus depreciation, all these other things that, it's been implemented for the past 3 years, and people are still just all of a sudden getting, the knowledge base of, okay, hey, I can be doing that. I should amend my taxes later, or prior to this, and actually apply that to properties that I've owned for the past 3 years. Those types of things, if you don't know that stuff and you look at it as, just one specific asset, you can really hone in and have tunnel vision on the rest of what your life could be, or, the investing career could be. So, enough about that. But the biggest thing for me to, and you is like, you look at these deals and you say, hey, this is one of many, versus, one that is going to set me back for the next 10 years. And then I'm going to try to recoup. No, you got equity, you have, those tax benefits and everything else, rental increase and all that. So with the business now and, getting these properties, what markets have you been, the biggest success, and what markets have you had, mediocre or average success in?
We work in two main geographic areas throughout the United States. We work in the Midwest. These are mainly rehabbed properties. This is what a lot of people think about when they hear turnkey. This is a rehab, a 1950s, 4-bed, 2-bath that's been rehabbed, probably $150,000 on average. This is your bread and butter workforce housing. It is a low barrier of entry to acquire rental real estate. If you have limited capital, this is a great starting point. These are very slow and steady, stable markets. So this would be an area that I would consider more of just your mediocre returns, but it's also expected to be that way, right? This is just a slow and steady cash flow property that will appreciate over time, but it's not like you're going to have crazy growth. Alternatively, the other area we focus on is the Southeast. I mentioned some of those markets, but mainly this is areas in Texas, all throughout Alabama, Carolinas, Florida. Florida is probably one of our biggest markets, Florida and Alabama. These are areas where their growth markets is. And this is almost exclusively new construction. Average house price there could be $300,000. So a little bit more money down to buy the property, but certainly higher growth potential in these areas. We have some people that have sold their properties over the past couple of years. I mean, we all know the post-COVID run and appreciation that a lot of markets have had. Well, that's certainly slowed nationwide, but these are areas that are still appreciating strongly. And this is mainly largely in part due to supply and demand. Population, we know, is shifting down to the Sun Belt, and construction is slow, so there's not enough housing solutions. Those are areas where we've done exceptionally well. And I think where the best opportunity is, especially in new construction. You mentioned, the short-term rental and the tax benefits with that. I mean, that's a strategy we work with a lot of investors on. There's some people that could justify real estate professional status, owning multiple properties, especially across different states, and they get to take advantage of accelerated depreciation. A unique thing we work with people is as well. And I'm not a CPA or attorney, but we certainly have excellent real estate CPAs and attorneys on our team to help guide you as well from a comprehensive standpoint in building a business. But I mean, one strategy would be, say, we have a high-paid professional, a doctor, engineer, whatever the case, and their spouse is also a high-paid professional. They're just starting to they have high income, pay a lot of taxes. They're just starting to invest in rental real estate. They will potentially buy a property, operate it personally, and manage it personally with some guidance from us, and furnish the house as a short-term rental. That allows them to take accelerated depreciation on that house. So if it's a $300,000 house, that could be potentially an $80,000 to $100,000 immediate tax deduction that year, which dramatically reduces their taxes. That could translate to, I don't know, potentially $40,000 of actual money that you're going to give to Uncle Sam and never see again, versus that's a down payment on another property or partially. And you can actually invest on that. And guess what? Buy additional assets that have additional tax benefits, but they'll operate that as a short-term rental for that year. And then because you need to do that the year that you put it into service, you need to self-manage it to potentially take accelerated depreciation. You do not have to be a real estate professional in that case. And then they could turn that over to, our managerial team the second year if we want our team to manage it for them, or they continue managing it because they've learned how to do that. And it's a good experience. That was just one creative scenario I wanted to share with you that's applicable to, some people on how they're being creative to invest in some of these growth areas and use unique strategies to maximize tax benefits.
Yeah, no, exactly. And I've done it myself, and still do it. And then also have a lot of friends that do it as well. And, they've gone back, and I've mentioned this a couple of minutes ago, but amended their taxes from past year as well. Obviously speak with your CPA, but, and been able to still utilize the cost segregation on properties, long-term, short-term, and midterm. Obviously there are going to be different things there where, the property is going to depreciate and also have other items in there to depreciate. But overall, those things really help out a person that, is getting hit every year on taxes because they're high income earners, or, they're married and both of them are very high income earners. So that's where a lot of people, they learn about this. And actually, I just got a client that brought this up to me. I know that we've reduced down to 80% last year and then 60%, but they have a docket or a bill coming up that potentially would reinstate it next year for 100%. I'm not sure if I didn't know that, but that's something that potentially could be, passed. Hopefully it does. That's one thing to look into as well, because if it goes back up to 100%, then we're in a better scenario. But
we have, I mean, that's just one example, right, of how you can be a strategic investor taxes are the biggest expense. And I'll try not to get too much on my soapbox here, Peter, because we could spend all day talking about this, but that's just one prime example where, you can get so much further ahead, because if you were to take, accelerated depreciation on a property that you buy, let's say, again, use a $300,000 example. Most of our studies come in. I literally just got back from our cost seg guy yesterday, our studies for this past year, and our studies were between 30 to 43%. These are actually all except for one was all new construction. New construction does carry more depreciation benefits than older homes. But if you look at that $300,000 house, let's call it at 33%, that's $100K that you can reduce your taxable liability wise. That could be significant money that you can then invest and accelerate. Like, your return on investment is infinite if it's money that you were otherwise paying to Uncle Sam, but now you actually get to invest that money, earn a return on it, and then buy additional tax assets. There's this snowball effect, right? And depreciation is recapturable when you sell. However, you can 1031 and pay that forward and perpetually, defer those taxes. Ultimately, then your kids get a step-up basis, so on and so forth. Our business, we have a successful business, and we, make good money in rental real estate investing. Our goal every single year is to buy enough real estate to wipe out our taxable liability to zero. Every single year. And we've been able to do that for the past 5+ years because of things like that. So, you need to know about it. Secondly, you need to take action, actually invest and do it, and then apply these concepts, right? But that's how it doesn't happen overnight. But financial success and generational wealth can be created through rental real estate investing, really in my opinion, in a short period of time with a very intentional and dedicated investing, especially if you are looking at the U.S. as your landscape and specifically choosing markets where the best opportunity is and that are most conducive with your goals. So that's my little soapbox pitch on that.
No, and I want to second that. And then two, a thing to couple with that is a lot of people that are maybe 2 to 5 rentals or 2 to 10 rentals. And this is just, I guess, my soapbox for a second, is a lot of people will come and they say, hey, I don't raise rents because I kind of let the tenants do fixes on their own and everything else. And I feel like that's a disservice, especially to investors, for each and every property, because that's as we say, an asset, and the property value goes up for maintenance that you do on deferred maintenance, as well as any repairs and any upgrades. So ultimately, when you go, for one, sell that property and you have done deferred maintenance, that's why a lot of these wholesalers get a lot of these deals, and a lot of agents get people to call them and say, hey, it's been a rental for 30 years. I've had it and I just haven't taken care of it, and I really never raised the rent. For one, that's a hit on the equity position and appreciation for the property. And then two, speaking about actually making sure that that asset is a well-performing asset. You need to increase the rents each and every year, because not only do you hit inflation like we've experienced the last year and a half, 2 years, you also have other things like taxes going up, insurance going up that we've experienced the last year and a half, 2 years. And then other things that do come up where the tenant can't fix. Hey, now we have a slab leak and we have to tear up the concrete. Well, I have to call the insurance because I don't have $5,000. These are things that are very crucial for you as a smaller investor if you don't have someone like Zach to take care of you. And you need to do throughout the whole process of having your properties, because when you go sell that property or you sell it as a portfolio to a portfolio investor, they're going to look at those returns versus and what your expenses are the last 3 to 5 years. Hey, looks like no expenses. That's great for you, but that's not great for me. That means I'm gonna have to put $100K into these properties. So I'm not going to buy it for, $1 million or $2 million. I'm going to buy it for 700,000.
You need to be a good steward. I couldn't have said it better, Peter. You need to be a good steward of your money, of your investments. There's no such thing, even though we work in the passive investing like category, there is no such thing as true passive income, because you always need to be monitoring these things. Even if you have a property manager, you need to hold them accountable and have a strategy and plan with them. We raise rents on average 4% per year. That should be an expectation. You know what I mean? The market is certainly raising. Your competitors are raising, and so you definitely need to do that in future projection. Again, I'm a big advocate for running the numbers on these things forward thinking, not just year one. But if you look at the compounding effect of raising rents over time, it's dramatic, right? I mean, 4% every single year, or whatever that case is for your local market. Like on our website, we have what we call a wealth tracker, where you can go on and project like, okay, well, this is my portfolio, of course, track performance, but you can also say, all right, in year 5 or 10 or 30 years down the line, if I, increase rents by 3.5% per year, and if I have a whatever moderate 5% appreciation per year on average, this is what my portfolio is going to be. And you can kind of reverse engineer your retirement dates. But I mean, just to visualize that, it is dramatic, little changes over time. So I agree with you 100%.
Yeah. Well, so rent to retirement. Let's talk about that, and wrap this up on, what else you guys are doing. Let's say in the next 2 to 3 years, what do you look at as, business planning, where you guys are projecting, not so much on how many investments, but, where do you want to build this thing out to?
So we are definitely moving more the direction of build to rent and new construction. I actually think we're more in the build to rent space than turnkey. About 70% of the properties we did last year are new construction, and we're going to move the needle on that to be probably about 85 to 90% this year. And I don't know, I think I just like new construction, and especially in growth markets. That's still mainly single family and small multi. That's our bread and butter. We will focus on, we've just recently launched our academy, which is just your baseline educational program and coaching program for people who are not ready to buy that first property yet, or even if you are, you just need some tools and resources and guidance on how to get that first property under your belt in the next 90 days. That we actually refund people their investment for that course when they invest in rental real estate, because that's the whole idea behind it, is encouraging you to buy real estate and invest and actually take action. We're really interested to offer more short-term rentals, mid or medium-term rentals. I think there's opportunities where you can really dramatically increase your income. Of course, we talked about the tax benefits potentially with those, but just increase your income in areas that are opportunistic, that might operate well as midterm rentals or short-term rentals. We currently have a few on our board. I think that's an interesting space, especially the midterm rentals where you have things like traveling nurses and just 1 to 3 month tenants. Often you can get a corporate lease from a company where they're just turning, right? There's people like they're on constant rotation. It's really a low manage, like you could self-manage that very easily. Yes. And just kill it on the returns in the right location. And those are pretty quality tenants because they're usually professionals. So those are some of the exciting things on the forefront. And yeah, we're all excited for interest rates to cool down a little bit, hopefully over these next couple of years.
Yeah, as they've already trended downwards just because of the Fed's conversation, but it's definitely good to see that they're going down or trajectory is going down this year. For me, it's a double-edged sword because everybody always gets a little bit more, concerned when it's election year. But the thing is you do have those rates going down, the inventory and those items, on the table for, going down 3 times is something that's definitely big. And then also the inventory crunch is where we see a lot of the returns at.
Can we talk about that just real quick, Peter? Because I think that this is really important. Guys, I think right now, and I'm not sure when this episode will come out, but like right now is a really essential time to make action steps for this year. A lot of people wait naturally towards the end of the year if they're looking to take action because they put it off. But especially with where we're at. So over the past 2 years, we've just went through like the most dramatic increase in interest rates, the most aggressive increase in interest rates in the shortest period of time that we've seen in the past 40 years. And so what that has caused is obviously, and that's largely in part because we came from like record low interest rates, right? And that was out of necessity. The Fed's always reactive, but there was a lot of people that obviously have been sitting on the sidelines. A lot of people expected the market to correct, and it has corrected in some areas, but actually not to the extent that most people would expect that to happen. And again, supply and demand. There's an inventory shortage, especially in the markets that we work in. There's been constant, there's low inventory, but there's also a lot of investors, institutional buyers. They pulled the brakes back or put the brakes on a little bit during this period of time, especially newer investors. And so my whole point is that there's opportunity to buy right now and inventory availability that will be more competitive, in my opinion, in the next 6 to 12 months. You can always refinance your loan. Like if you buy a property that's cash flowing now and makes sense now, one of two things is going to happen. You're either that property is going to continue to cash flow because you're buying it right now. Interest rates will stay the same or go up or whatever, and you're a happy camper because you closed your loan, you bought a right property, let time do what it does over time, or interest rates will lower. And during that time, obviously there's more investor activity. There's going to be more competition, price points, appreciation goes up. Plus you can refinance the cash flow better. The point is there's more opportunity right now where there's not as much investor activity. My opinion is be aggressive now before the curve. I mean, would you agree with that, Peter? What are your thoughts?
I say yes. I say that last year, even when interest rates were going up in 22, I was buying because we were able to get deals where it was and obviously everybody really didn't know what 2023 held. And I agree with you on the fact that right now is on the cusp of something where we'll probably once we hit the spring market, it's probably going to be in a situation where low inventory rates are going to probably the first drop in interest rates from the Fed is going to be roughly around March. And then they're going to trail into the election time. And that 6-month window is going to be pretty heavy on people jumping in the market, buying stuff because the interest rates are going down and they're going to hear it on the news. And then they're going to want to try to taper off once they hit the election because they don't know what's going to happen between November and January. They don't know if it's, one party or the next. And I think that if you weren't investing last year, this is definitely a good window to jump into because you still have those. I just got a fourplex. We're closing tomorrow, $100,000 off, 24K back at closing for a client because they had sat on the market. Yeah, they were overpriced. And then we also were able to get one of the tenants out and the seller paid cash for keys to get that tenant out because they wanted to close it and it had been sitting for a while and rates are still high. And they're higher comparatively to 2021, but I do agree with you, Zach, 100% is this is the cusp of where you should be getting in right now before rates start going down even more, and then there's going to be more of a frenzy because the inventory is. I just saw yesterday demand's up 10 to 12% on buyers, of course, because they keep hearing the interest rates are down.
Yeah, so I mean, it's all about finding a way to be consistent and invest in any market cycle, but as far as timing goes, right now is a good time to, make some big moves to be positioned where you're ahead of the curve. So can I give out our information, Peter, if people are interested?
Please do.
So we, our company, Rent to Retirement, the best place to go is just to our website. That's Rent to Retirement, rent2retirement.com. We have our podcast, all sorts of information we put out on our YouTube channel about all things real estate. Certainly feel free to follow us. Check out our inventory there. If you're listening to this in the car, you can text REI to 33777 to get on our email dispo list. And for any agents out there, we also have an excellent referral program. If you are yourself or you're working with investors that are interested in investing, out of state or in some of the markets we focus on, certainly be happy to collaborate with you. So that's how to find us.
Perfect, man. I appreciate it. Anything else before we get off? Is there anything that I didn't ask you that I should have asked you while we were on the podcast?
Man, well, we could probably talk forever, especially when we go down the rabbit hole of tax benefits, investing and analyzing markets. But yeah, guys, there's still some markets out there right now and over the past years that have seen double-digit appreciation, both in rents and appreciation. So if your local market isn't experiencing that and it's becoming more and more painful to make deals happen there, again, the most pivotal moment for my wife and I that completely changed the trajectory of our investing in our lives, for that matter, is learning how to invest out of state where there's better opportunity in building a diverse portfolio. And so I encourage everyone to at least explore that to some degree.
Dude, everybody jump on Rent to Retirement. Check the website out. Obviously, Zach mentioned about an academy too. They'll put the money back into basically your bank account if you get that investment as well. So, and we'll put all that in the show notes. I appreciate you, Zach. Thanks for coming on, and thanks for telling a little bit about your story, especially those hard-hitting properties that you first got, and then expanding on what you're doing today. I appreciate you coming on.
Thanks so much, Peter. It's been a pleasure.
Thanks, man.